Okay, Chapter 9 is on long-term fixed assets. These are assets that a business is going to utilize for longer than 12 months. So businesses buy lots and lots of assets that they use for multiple years. The three categories are tangible, fixed assets. This is property, plant, and equipment. These are the buildings, the computer equipment, the delivery trucks, the manufacturing machinery, the office equipment. Everything that is tangible has physical substance. All right? Tangible fixed assets are expensed with depreciation. Okay? We depreciate tangible assets to systematically spread the cost of those assets over the life of the asset. The second category is intangible. These do not have a physical substance. They're still value. They're still owned by a business in order to conduct their operations. These include trademarks. Everybody knows what this is, right? McDonald's arches, the Nike swoosh, the Coca-Cola wave. Did you know they had a wave? Every product's got some sort of little wave thing on there. I don't know what Adidas is. What is that, a flower? Is that
I thought it was this is a flower, but only 3 stripes.
Oh, the 3 stripes also is a trademark for Adidas. Yeah, that makes sense. Okay? So all of that has value, and they defend it strongly. So that's intangible. Intangible assets that have limited lives, not all intangibles have a limited life, are expensed with amortization. A limited life is a patent. A patent is only good for a limited number of years. Most patents are good for 25 years. We expense patents over their useful life. And I'll do an example of that. So if you've got a patent for 25 years, but you only intend on using that patent for the next 5, then you expense the cost of either acquiring the patent or registering or defending the patent. Whatever the cost is associated with that patent, you expense over the useful life, not the legal life. Because remember, at all phases of this adjustment process, at the end of every period, you're matching revenues with expenses. So if you're not going to generate revenue from this patent beyond 6 years from now, it makes 0 sense to continue to expense it in year 7 all the way to year 25. Even though you have the legal right to it, if management is not going to use this technology for longer than 6 years, which in in software, computers and stuff like that, that's very common. You build a chip for a new phone, you may get 2 years out of it. So you're going to build a new chip in a couple of years for the new phones. They're not going to want to use the old chip anymore. All right? So it's the useful life that you amortize patents. Copyrights, how many books are you going to publish under this copyright that you acquired from the author? Copyrights are also limited in that they have a useful life, but they're also limited for 50 years beyond the death of the author. Okay? So Hemingway died in, I don't know, the 50s. So he's probably coming up on free, his copyright is expiring. Which is why you can download Mark Twain and Shakespeare for free. Because the copyright's gone. Alright? So that's intangible assets that we amortize expense. The last one is natural resources. Natural resources get expensed through depletion. This is oil and gas, timber, minerals, the caliche rock that they dig up all over town in the quarries that surround San Antonio that you make into cement. All right, that limestone that seems that all of San Antonio is built on has value, and they dig it up. That gets depleted. Coal, diamonds, it's all expensed by depletion. All right? So these are the three major categories. For today, I'm really only going to focus on depreciation and a little bit on amortization. Okay? So let's talk about depreciation. For purposes of this class, we are going to systematically expense long-term, tangible property, plant, and equipment in one of three ways. Straight line, which is abbreviated SL. Straight line depreciation is an even spreading of the cost over the useful life of the asset. We're going to take the same depreciation month in, month out, year in, year out, while we own the asset. Units of production. Rather than spreading it out over the useful life in years, you could spread it out over the useful life in some other unit. Let's say you own a fleet of taxis or rental cars, and you regularly drive these vehicles until they reach 100,000 miles. And then you get rid of them and buy a new vehicle. Well, you can depreciate it over the miles driven. You estimate you're going to get 100,000 miles out of this vehicle. You take the depreciable base, which I'm going to talk about here in a second, and you spread it out over 100,000 miles, and you get a depreciation rate per mile. That's units of production. You can do the same with a manufacturing piece of equipment that produces a product. Say it's a big press, and you estimate it's going to be able to stamp out 2 million widgets in its life. And then it's going to wear out, and you'll have to get a new one. Well, you can do it by units. Calculate how many units it produced this year, multiply it by the depreciable rate, and get your depreciation that way. You can do it by hours. A lot of machinery runs by hours. It's got a Hobbs meter on it. Generators, for instance. You estimate it's going to run for 200,000 hours. And you depreciate it on a per hour basis. And then lastly, double declining balance. This is an accelerated rate. So you're going to take more depreciation early in the life and less depreciation later in the life. And the logic behind this one is really twofold. One, when a machine is brand new, it is producing at its peak efficiency. It's a brand new machine. You're going to generate the most revenue out of this machine, whatever it is, in its early years than you will in its later years. Because it's old technology. It starts to break down. The cost of maintenance starts to increase, which is the second reason people do double declining. Because the depreciation is going to come down over time. This is time. This is depreciation. PR. But the maintenance cost on the machine is going to climb. It's little in the early years, but as it gets old and it wears out, you spend more and more money on it in order to keep it running. And so that levels out the total cost of depreciation plus maintenance. It kind of evens it out. So that's the logic behind double declining balance. So let's talk about how we do all this. We'll start with example exercise 9-1 on 9-11 on page 443. So exercise 9-11 on page 443. All right, on this, prior to adjustments at the end of the year, the balance in trucks is $296,000. The balance in accumulation on trucks is 99,720 miles, or $20. The details of the subsidiary ledger is as follows. So it has truck number 1, 2, 3, and 4. And it gives you the cost, what the estimated residual value was, the estimated useful life in total, how many miles are you going to drive each of these vehicles, and it gives you the accumulated depreciation at the beginning of the year, and then how many miles it has been driven during the current year. So determine the depreciation rate per mile and the amount to be accredited to depreciation expense and all that stuff. Okay? So, in any depreciation, tangible depreciation exercise, you're going to start with the cost of the asset. All right? And what we have here is we have truck number 1, number 2, number 3, and number 4. The cost on truck number 1 was $80,000. $54,000 on 2, $72,900 on 3, and $90,000 on truck number 4. From that cost, you're going to remove the salvage value. This is what, when you're done driving it, and you're ready to either trade it in or sell it, this is what you estimate you'll be able to get for the truck. All right? And it gives you the estimated residual value on each truck. So $15,000, $6,000, $10,900, and $22,800. If you subtract that from the original cost, you get the depreciable base. This is the net cost of owning this asset. All right? Because you bought it for one price, you're going to be able to sell it when you're done with it for another price. So the net is what you need to evenly, somehow, systematically expense over the life of the asset. All right? So, this one is $65,000. This is 48,000. This is 62,000. And this is 67,200. That's not on my sheet, so I had to do that one in my head. It is telling you in this chart what the estimated useful life in miles. So we're going to drive truck number 1 for 250,000 miles. Or a rate of 26 cents per mile. Truck number 2, 300,000 miles. Or a 16-cent rate. Truck number 3, 200,000. Or a 31-cent per mile. Truck number 4, 240,000. Or 28 cents per mile. So this is units of production. And the units in this case are miles. And then it tells you, the last piece is miles driven. During the year. So we drove truck number 1, 21,000 miles. We depreciated at 26 cents per mile. So we have a depreciation expense of 5,460. Truck number 2, we got 5,360 out of it. I'm sorry, no. 33,500 miles. And the depreciation expense is 5,360. Well, you drove truck number 3, 8,000 miles. For 1,860, and then 22,500 for truck number 4. So in total, we have $18,980, which will be our depreciation expense trucks. $8,980. And accumulated depreciation on trucks for that. All right, does that make sense? So that's units of production. Let's do exercise number 12, which we'll do for straight line and double declining on the same page. All right, everybody got this one?
Yeah.
Well, no, this is the depreciation part. I need it down.
Oh, what, the bottom line?
Yeah, the bottom line.
Did you get it for number 1?
Yes, Yes, sir.
Okay, if not, you'll have to go back and look at the video. Pause it. Okay, on 12, this one, a John Deere tractor acquired on January 4th at a cost of $120,000. Has an estimated useful life of 25 years. It will have zero residual value. So the cost is $120,000. It has zero residual value. When you're done with it, you're just going to go haul it out in the field and let it rust. Which seems to be what they do with tractors. If you've ever driven out in the countryside, they seem to be littered. God bless you. So the depreciable base on this one is $120,000. The useful life is 25 years. So for straight line, you divide the $120,000 depreciable base by the 25 years, and you get $4,800. And that's year in and year out. The question is asking us, what is the depreciation for the first 2 years? So in year 1, it's $4,800, and in year 2, it's $4,800. It's the same. Double declining. For double declining, you need to set up a table. Table is years, beginning book value, and we're only doing years 1 and 2 on this particular problem. A rate, and I'll talk about what the rate is here in a second. The depreciation expense, and then ending book value. Okay, book value is the cost of the asset minus the accumulated depreciation. All of the depreciation that you've taken. So what's the book value for this tractor at the beginning of year 1 when we bought it? $120,000. This is where double declining balance differs from units of production or straight line. Both of those use the depreciable base. This uses book value. Okay? So $120,000 is book value at year 1. You're then going to multiply this by a double declining rate. The rate is the straight line rate times 2. The straight line rate is 100% divided by the useful life, which in this case is 25. That equals 4%. Double that, 8%. If you multiply the beginning book value by 8%, you will get $9,600 in depreciation expense for the first year. So at the end of the first year, our book value is now $110,400. Which is the $120,000 minus $9,600. That becomes our book value for the beginning of year 2. Multiply that by 8%. You get 8,832. I'm not even going to guess as to what the book value is at the end of the year. Make a calculator. But that's how you do double declining. And I'm going to do some more examples of that all the way through. So the difference between double declining and straight line in units of production is, in this case, you depreciate it down to the salvage value, which in this simplistic problem was 0. But in another problem that we're going to do here shortly, there will be a salvage value. Okay. All right. Let's do a more complicated one. I'll come back to this one. Let's do problem number 2 on page 447. So problem number 2. On page 447. This is a comparison of all 3 methods. So on this one, it says Moore's Coffee Company purchased packaging equipment on January 1, 2014 for $90,000. The equipment was expected to have a useful life of 3 years or 20,000 operating hours and a residual value of $6,000. The equipment was used 8,900 hours during 2014, 7,100 hours in 2015, and 4,000 hours even in 2016. So depreciate the depreciation expense under straight line, double units of production, and double declining balance for the life of the asset. Well, not for the life. They just want the first 3 years. For 2014, 15, and 16. All right? So the cost of this asset was $90,000. It has a salvage value of $6,000. That's what we're going to sell the packaging equipment or trade it in at the end of its life, giving you an $84,000 depreciable base. It's only going to be used for 3 years. Yep, a useful life of 3 years. Packaging equipment must wear out quick. Divide the $84,000 by 3 years, and you get $28,000 per year for straight line. So 2014, 15, and 16, you would expense $28,000 per year for this packaging equipment. All right? Using the same depreciable base of $84,000 under units of production, only now you're going to divide it by 20,000 hours. And that's going to give you a $4.20 per hour. rate. In 2014, we used it for 8,900 hours times the $4.20 for a total of $37,380. In 2015, we got 7,100 hours out of this machine times the same $4.20. For $29,820. And then last year, the final year, we got 4,000 hours out of it, $4.20, and that is the remaining $16,800. So for double declining, the book value at the beginning of year 2014 is the full $90,000 that we paid for it. That's the original cost of $90,000 minus 0 accumulated depreciation. So what's the straight line rate for a 3-year property? What's 100% divided by 3? 33.33%. Doubled. 66.66%. Or 2/3. What's 2/3 of 90,000? What's a third of 90,000? 30,000. 60,000 is the depreciation for the first year under double declining, leaving you with 30,000 in book value. 30,000 is the beginning book value for year 2. 2015. 2/3 of that is 20,000, leaving you with 10,000. $10,000 is the beginning book value for 2016. What's 2/3 of that? $6,660. We have a problem. The ending book value has to be equal to the residual value. We're going to be able to scrap this machine for, $6,000. If we take 2/3 of the book value at the beginning of 2016, we will over depreciate this machine by $2,666.66. We don't do that. So what do we have left? $4,000. That's the depreciation in the final year. You'd never depreciate it below the residual value. Okay? That's a fun one. Let's do the sale of an asset. number 18, exercise again, number 18 on page 444. Equipment acquired on January the 6th, 2013 at a cost of $425,000. So the cost of $425,000. It has an estimated useful life of 16 years, and a residual value of $65,000. That's going to give us a $355,000 depreciable base. $360,000. Sorry about that. $360,000 depreciable base, divided by a useful life of 16 years, which is $22,500 per year. Straight line depreciation. It goes on, and it says, what is the annual amount of depreciation in the years 2015, 13, 14, and 15? Can't read this anymore. Under straight line, $22,000 each year. It then asks you, what is the book value of the equipment on January 1, 2016? So 3 years of this is going to be $67,500. If you subtract $67,500 from the cost, the original cost of the equipment, you get $357,500. That's the book value. It then asks you in C, if you sell it for cash of $340,000, what's the entry? Well, first, just let me ask you a business question. If I have a piece of equipment that's worth, to me, book value of $357,500, and I sell it for $340,000, is that a good deal or a bad deal? That's a bad deal, right? Because we're losing money. We're selling it for less than it's worth on the books. So to sell this, we need to remove the accumulated depreciation of $67,500, because we're getting rid of all trace of this equipment. And we need to take a loss on sale of equipment. Of $17,500. And then we write off the equipment by crediting the equipment account for the $425,000. So that's if we sell it for $340,000. What if we sell it for $372,500? Is that a good deal or a bad deal? That's a good deal. Now we have a gain on sale of equipment of $15,000. Okay? All right, let's do an amortization, just so that you're introduced to it. This one's easy. Leave this up here. We're going to do problem exercise number 20 on the same page. 444. On this one, Smith Company acquired patent rights on January 1, 2013 for $882,000. The patent has a useful life equal to its legal life of 9 years. So there's 9 years of the 25 left on this patent. On January 1, 2016, Smith successfully defended the patent in a lawsuit at a cost of $45,000. Determine what the expense for the year ending December 31st, the amortization expense for the December 31st, 2016. So the patent originally cost $882,000. And it was good for 9 years, for a total of, I don't know. Let's do the math. $882 divided by 9. $98,000. That was at January 1, 2013. So we depreciated it, or January 6th. We depreciated it 2013, amortized it. Amortization of $98,000 for 13, 14, and 15. At the beginning of 16, somebody encroached on our patent, and we had to take them to court. And we won. But it cost us $45,000. How many years are left in our patent? We had 9 at the beginning of 13. It's now the beginning of 16. So there's 6 years left. $7,500, $100, and $5,500 is now, for 2016, our amortization expense. So the key thing to remember is you amortize patents or any intangible asset that has a limited life over its useful life, not its legal life. this case, it was the same. All right, the last problem, which is kind of a combination. Problem number 4A on page 4, well, it's at the bottom of page 447, and it continues up on page 448. So problem number 4A on page 447 and 8. All right, everybody got this one? New lithograph equipment acquired at a cost of $800,000 at the beginning of a fiscal year. It doesn't say what year. With a useful life of 5 years and a residual value of $90,000. So it cost us $800,000. With a residual value of $90,000. That is $710,000 of depreciable base. Five-year useful life, straight line depreciation is $142,000. For double declining balance, I hate it when that happens. Battery wore out. Here we go. Got a new one. For double declining balance, the book value at the beginning of the year is $800,000. What is the book value at the end of year 5? It's on the board. $90,000. Because that's the residual value, the salvage value, $90,000. So a 5-year property, what's the straight line rate? What's 100% divided by 5? Really? 100% divided by 5. 20%. Double that, 40%. 40% times $800,000 is $320,000, leaving you with $480,000 as ending book value. 480 multiplied by 40% is $192,000. Now you have $288,000 at the end of year 2 for book value. 288 times 40% $115,200, $172,800, $172,800 times 40% is $69,120, leaving you with $103,680 in book value at the end of year 4. So if you were to multiply the $103,680 times 40%, you would get something to the north of $40,000. Too much. Because the residual value, the salvage value, is $90,000. So all that you have left is $13,680 to be able to depreciate for the 5th and final year. And one last. What if you were to sell this at the beginning of year 5? So in the first week of the 5th year, you sell this for $135,000 in cash. Is that a good deal or a bad deal? Good deal. Because you have a book value of $103,680. So you have accumulated depreciation for the equipment of $696,320. You have $800,000 in the original cost. That's your credit to the equipment account. And gain on sale of equipment equals $31,320. All right? Let's review for the midterm. We got 18 minutes. Turn this off.